you very much for joining me. I'm Chris Swift with Swift Trading Company, Chief Cook and Bottle Washer. I want to take a moment to thank my associate Chris Winward for the fine job he did producing this webinar. Over the course of the last 5 or 6 weeks, I've been trying to tell my clients and tell people about what I perceive is fixing to happen into the feeder cattle market. I think we're fixing to have a C-wave decline in the market. I use the Elliott wave a great deal in my analysis and attempting to forecast what future prices will be. The Elliott wave, just the premise of it real quick, is based upon the habits of traders and those habits forming patterns, and those patterns being attempted to be recognized by traders, analysts, to predict the next most probable move that will come to the market. As you can see on the chart in front of you, it takes on multitudes of patterns under different magnitudes, and each one of these magnitudes can create a larger and or smaller depiction of the larger wave count. In this case, we can see that a 5-wave move up, which could reflect everything from initially a bull market getting started with some kind of supply and demand factors being upset. The third wave may have a tendency to expand a little bit, relaying the full force of that bullish move or bearish move, either one. And then the fifth wave is a finalization of it, and we tend to have cycle turns in either the production of or the lack of production of in order to turn the market from plus to minus or minus to plus. After these 5-wave tendencies happen, you look for a correction in the market, and it's a cooling off time frame. It's people taking profits. It's the change of fundamentals. In this particular case of what we're looking at in the feeder cattle, after a 5-wave move up, this is the weekly feeder cattle continuation chart, we can closely resemble a 5-wave pattern that has transpired in the feeder cattle, with which we initially had some type of disruption in the supply-demand factor. That supply and demand factor grew more towards the demand and less supply side. And then what we hit in the 5th wave was just the extended part of the cycle that we were in that was very friendly towards the feeder cattle and fat cattle markets. Now the cycle is beginning to change, and we have seen that change with the increase in production, the decrease in demand. And with that, the feeder cattle market appears to have put itself into a position in which it creates a very poor profitable margin for feed yards. So with the anticipation of a C wave after a 5-wave move, we get a 3-wave correction. My analysis says we've already seen the first wave down, and this past summer has produced a smaller correction of that A wave down, which is the high of the year. This is the feeder cattle index, so this is the cash, and of course they're going to mimic one another very closely, but not always tick for tick, due to premiums and or discounts that the futures can have that create the basis to the cash indice. So we've seen the same pattern in this. And then we come down and we're going to try to apply each one of these with this C wave to each individual contract month. And I've chosen 3 contract months that should be relatively large in production for the producers to be able to market cattle. The fall of year tends to be a heavier marketing area. So we want to try to hit that marketing area and try to assume what these prices are going to be. So on a per contract basis, the October contract from contract high, and this was also the historical high that was on the weekly chart up here. So that measured $40 from top to bottom. The Elliott wave suggests that on a simple ABC correction that the C wave will be equal to the length of the A wave in price minus the B wave high. In this case, my analysis believes that the B wave high was what we saw this June. In the October contract, it was 223.40. If you subtract the 223.40 from the October contract there, I think I've messed up the target there, but I think that target is it is 183.40. So that's where I believe that we're fixing to move the feeder cattle down into. This would finish completing the entire correction from the contract high down to here. The reason I think and these correction patterns can take on a multitude of formations. The reason that I believe it's going to happen in a simple ABC correction rather than a long, drawn-out sideways or triangular pattern is because of the fundamentals of the feeder cattle. And those fundamentals appear to be very tight supply issue at this time, but a very increasing supply issue coming this fall. We can already see by the discounts of the futures in the fall months that there are other traders anticipating this lower trade coming this fall and the inventory increase. So with the inventory increase going to be so big, I don't think we're going to stagnate and then look to rise back again. I think we've got to take some of this premium off the market to restore the profit margins in cattle feeding. It can happen either through lower corn, higher fat cattle prices, or lower feeder cattle prices. We've already experienced an over 80-cent rally in corn, so even if corn does start backing up now, it's already made a relatively large advance. Fat cattle have been going down. They're in a downtrend, and I do not anticipate fat cattle to move higher anytime within the next probably 3 to 4 months. I think maybe towards the fall of the year, later fall of the year, we may have worked out to a lower level in the futures in which there becomes some price that is shows value, shows intrinsic value around that time frame. So for the October contract, if we subtract the A wave length to the B wave, we come up with a 183.40 target. On the November contract, it was almost a like move. It was $40.60. We had kept a discount, a little bit smaller discount in the November contract, so subtracting the 40.60 from the 221.50 high, it projects a target to 180.90. The length of time for it to do that is real close to equal of what I think the A wave will be as well. It could be a little bit longer. It may be much more drawn out, as in if you look back at the A wave, we had exceptional volatility. And that's because the market was coming right off the top and had tremendous amounts of participants in there that the market needed to either have them move into the market or move out of the market. After some time has cooled down now between March and present, I don't think we're going to see the collapse in the market similarly to the way we did on the A wave, again, because we are in a tight situation right now, and that is probably not going to be relieved until we start to see the first pastures lose some of their quality to them, and then we begin moving animals off those pastures. For the January contract, because it came on the board later than what the contract highs were made, I used the B wave, length of the B wave, and times it by 1.618. They gave us a $39 target. We subtract $39 from the $214.15, and we come up with $175.15 for the January contract, which is right in line with what the October and November contracts measured to as well. The lower price for the objectives that we're seeing is due to the contracts already being discounted, not any greater move. And to look a little bit out into the spring of the year, the April contract has just come on the board, but we see here at 203.20 and even the May contract less than that, we're already approaching the $200 level. Similarly to what we did in the last year, the premiums in the futures, the cash market went up and eventually met those premiums. This year it's just an opposite. The futures are holding discounts to it, and I anticipate the cash market to move down to the discounted level of the futures. And this shows the discount. This is this afternoon's closings, or a little after 1 o'clock. So we can see that clearly August representing the highest contract month, but still approximately $6.50 off the cash market. So even the next 45 days that the market is looking at is anticipated for the cash market to move down at least another $6 and meet the futures here. Each month we subtract anywhere from $2 to $1 difference on that, and then the biggest jump coming from November to January. And a lot of this discount is because of the expansion that is taking place. I saw a chart yesterday that showed the heifer kill and cow kill being at the absolute lowest rate comparable to the total slaughter that's been in the last 20 some odd years. So we have really, in my opinion, held back tremendously more cows and heifers in order to increase the expansion of the herd. And I believe at the end of this month, July 24th, we're going to have the cattle inventory report, and we'll see if some of that is holding true through the actual statistics of whether we're growing the herd or not. So, and one of the reasons that I think we're growing that herd and still have a tremendous amount of feeder cattle to come this fall, observing the sales receipts this spring for all of the major sale barns, I never noticed a great variance. There was never 10, 15, 20% declines in those receipts for year over year. What there tended to be closer to was 2, 3, 5, and 6% declines, and in some cases they were even with. Because the problem has not been very much with feeder cattle. The problem was with cows. So a lot of the feeder cattle that they say, a lot of the product that they say was not out there is true. In the cow market, it did decline sharply, but the feeder cattle market probably still had plenty of feeder cattle out there. So this fall, when we saw those feeder cattle sales, and I continued to watch the placements, the observance is we were not placing the number of cattle into the feed yards that were being represented in the sale barns, because these are feeder cattle that we're trading. I believe that we saw a tremendous amount of potentially lighter weight feeder cattle class cattle move back into a pasture or backgrounding program until later on this fall when they could put some cheap weight on it. So I believe that those cattle are going to come back this fall at a significantly heavier weight, at significantly higher numbers, and hence the reason for the discount in the contract months. Touch on fat cattle real quick. This is the weekly fat cattle continuation chart. We broke to new lows last week. We closed at new lows. We continue to have a decrease in consumption by the consumer. From the wholesale side, everything looks about status quo. But what we notice is that more beef at the completion is being shoved into the cold storage and not into the consumer. The width of prices between proteins, pork, poultry, and beef is so outlandish at the retail side and even at the wholesale side. I believe consumers are finally taking appearance to this. Most analysts that I read over the weekend all said approximately the same thing. Consumer demand is down. The consumer is adjusted to what the price of beef is. So to see fat cattle come back down to what this major wave 4 low is right here, that's about 136. That's another $10, $11 from where we are right now. And between now and right around October is where I would look to see to make those lows in the fat cattle market. Now, I'll touch on something else real quick, and then this will end up the thing because we're pushing on time. Commodity production cycles. This is going to entail commodities in general, not just cattle or grains or anything. The low interest rate environment that we have been in over the last 7 years is anticipated to have increased commodity production infrastructure at a greater rate of speed than would it have taken place had the low interest rate environment not been here. I believe that it would have taken place regardless of whether low interest rates are here or not, but not at the rate of speed in which we saw mining, energy production, and grain production to swell in just the last 3 to 4 years. So much so that it has begun to affect commodity prices. So this is a long-term chart of U.S. 30-year Treasury bonds, and we can see that just this right.
Next set of that.
And I think that we are back again. So my apologies for that. So with the low interest rate environment, we can see that bond prices have gone up, lowering the rate of interest, and that the Fed funds rate, the rates in which banks borrow money, has stayed at literally 0 to a quarter. Larger corporations, larger producers have been able to use this low interest rate in order to increase the infrastructure for commodity production. So with that, we've also seen a rise in the U.S. dollar over the last year. Whether it's a flight to quality, whether the U.S. is just in less worse shape than all of the other countries, but people have been flocking to the U.S. dollar. The U.S. dollar in its rise has also helped to decrease some of the export demand that we have had and create a more deflationary environment. So we've got two factors. We've got a higher U.S. dollar, making our exports higher to other countries and our imports cheaper as we bring product in. And we've also had a low interest rate environment in which, in order to be able to produce these things, we had to have the capital to produce. We can see crude oil probably took one of the greatest jumps from this. And this 08-09 area was from the financial collapse, so I kind of disregard it just a little bit. But all of this area that we have seen in the price decline has a tremendous amount to do with the pipeline infrastructure that we created from Canada, the fracking that we have seen, and the natural gas production that we have seen here in the U.S., and the rising dollar. So everything combined there has created a lower and lower commodity in energy. And the two things that we need in order to build this economy up is energy and money. And we seem to have plenty of both and still not moving forward at a very quick rate. This is high-grade copper. Copper is one of the biggest utility metals that there is, industrial metals. And here it's broken out of a huge sideways triangle that went from 12 to the latter part of 14. Broke out a bit, still trading at new lows for the last 5 years, for the last 5 years that we've been in. So with the increase in mining and the lower interest rate environment, we've begun to push the metals down. This is platinum. And the charts that I'm showing are not meant to reflect any kind of correlation in the market, but an indirect correlation that, although they're not all down as big or as large in percentages, but they all are trending lower right now. And these are some of the commodities that we need to continue with our economic prosperity. This is soybeans. We can see that we've had a significant drop in soybeans because we've increased acres significantly, not only here in the U.S., but in South America as well. And again, the low interest rate environment is around the world, and we have created tremendous amounts of infrastructure to produce commodities that I don't think would have been around or would not have happened at this rate of speed. Last thing I want to show you right here, if you notice some of these commodities have started to plateau off after this decline. We plateaued a little bit in the platinum, we plateaued a little bit here in the copper, and we plateaued a little bit here in the crude oil. What I anticipate next is that since the trend in the U.S. dollar is staying and we are continuing with the low interest rate environment, I don't really see the fundamentals changing any that is going to stop this increase in production until we drive commodity prices below the cost of production. If that begins to materialize, and you begin to knock off some of the production or take offline some of the infrastructure that has been created, you could see the hyperinflation that most everybody was really anticipating when they started lowering the interest rates and flooding the market with liquidity. We did have some inflation. A lot of that inflation, though, was just pushing prices back up to previous levels they had been at prior to the collapse. So we can even look at beans here on here and see that prior to the collapse that we had, beans only went up about $1.50 more than where they were prior to. And now we're right back down at the same levels that we were trading right after the financial crisis. So with the infrastructure still in place, I do anticipate another leg down, potentially in grains, mining, and energy to new lows. These new lows are anticipated to put most price of most commodities under the cost of production. And that's when we begin to see some big cuts. How soon this will happen, I don't know, because I don't think we've even seen this last leg down yet. And until we do see this last leg, then it's going to be difficult to time. But while this market is moving in this direction, I think this is the time frame, the immediate time frame that we're going to have that new low, especially since crude is just only a couple of dollars from contract low. Most of the metals are not far from contract low. And even though we've seen a pretty good rally in beans and corn, it's nothing that couldn't be erased in a very short period of time. The biggest benefactor, in my opinion, was the equities market, because that was where the largest amount of liquidity could be flowed into from the investment standpoint. And companies and corporations benefited greatly from the low interest rate environment that helped to offset a tremendous amount of loss of income that they had from the financial crisis. Some companies have been able to prosper and do well, others not as well, but the total of the equity indices has pushed up to new contract highs and new historical highs on all three indices. So you got to kind of watch out a little bit with these new highs. And if you've listened to anything that I have written over the last several years now, you have come to the conclusion that I believe that all of this liquidity pushed in here is manipulation by the Fed, keeping interest rate low and trying to offset some of the problems that the financial crisis caused. Maybe another bubble within a bubble. But all this liquidity and the talk from the Fed suggests that the Fed is wanting to find a reason to raise interest rates. How they can do it under this environment, I'm not real sure, but I think that they can, and I think that they will, because they seem to want to so bad. If that begins to materialize, the last 6 years have been under a low interest rate environment. When we begin to change the fundamentals of a low interest rate environment, I anticipate a tremendous amount of change in the markets, equities particularly, and how these commodities play out towards the tail end of this leg down will give us some kind of idea as to what we might be able to anticipate time-wise when some of this may transpire. So this is pretty much what I've got. I just wanted to make kind of clear a little bit. I've had a lot of questions, and I know that my analysis and my writings can be confusing at times. I hope that this webinar has been able to provide a little bit of substance to what I write and maybe clear a little bit. And I'll be glad to open this up to any questions that you may have. So I have popped up a little black box there, and my associate Chris has walked in here, and I'll be glad to stay online for another 4 or 5 minutes or answer any questions that you may have. And one of them is, what do I anticipate corn to do? I don't have any changes in my corn analysis. I think that we could move December corn up to 472. I believe after we do that, then we could potentially be through the cycle period that we have for pollination in the corn. That will take some of the pressure off of it. Once the corn is pollinated, whether it's good, bad, or ugly, it's pretty much made. So I believe traders will adjust their positions to that. If the corn crop does turn out a little bit better, we do get through pollination. I believe the combination of that and the stronger dollar could work on corn to move back down again. Whether it sets new contract lows or not, I'm not real sure at this time. Right now, the best I'm going to guess for is about a 50% retracement of what we came from the 362.25 low up to the 454 high that we made today. So I think that's what we could see as far as a retracement back on the corn.
There's another one.
And let's see here. Is there a way to be able to see that? Okay, so we got the audio working.
Trying to pull it up. There you go. Right there.
Right here.
Yes.
Oh, here we go. Okay, great. Oh, now we got all kinds of questions on here. It just takes a little while to get this. So, we got the audio taken care of. And if corn sets new contract lows, will you still see a decline in feeder cattle prices? That will all depending upon the timing of it. I believe that corn and feeder cattle are tied. I believe that while we are still moving up in the corn market, we will come down in the feeder cattle market, and then we plateau off. Feeders may trade a stagnant sideways trading range through the month of August. Corn may pull back a little bit in a 50% correction. And then we come into the fall of the year, which is harvest for corn and harvest for the feeder cattle going into the feed yards. That's when we begin to see whether or not corn had just made a 50% retracement, and then we move back higher again, and then that would give the momentum to the feeder cattle market to push down into the 180 range. I don't think that feeder cattle are going to plummet. I don't think they are going to be as hyper volatile as the way they were in the AWA. I think because the fundamental situation has changed and we have lost some of that hyper volatility, we're going to start to trend. The pitch of the battle has changed, and instead of going back and forth, I think the bears are kind of winning a little bit over the bulls, and so we're pitching that battle more towards the downside. So it's not, I think we'll taper off in levels. I think we're sitting at a level right now in the back end between 210 and 214. Sometime within the next week or two, I think we'll move down another level, maybe another $4 to $5 lower, and begin trading that. And remember that the next probably 4 to 5 weeks, well, the next 4 to 5 weeks, we're going to have very few feeder cattle sales that will be large. So we're going to see the feeder cattle index directed more from fewer cattle being traded on there. So to answer the question, if corn sets a new contract lows, will you still see feeder cattle prices decline? I don't think we'll see new contract lows in the corn. I think all we'll see is about a 50% correction. And the feeder cattle, I think at best, will plateau again during that correction, and then we begin to resume the trends back again, whether that's higher corn or lower corn. I think feeder cattle, I don't think corn at this time can be a great enough factor to offset the higher price of feeder cattle. Another question, if you look at the COT report, put-call ratio or other tools, where are we right now on the September feeder chart? Will there be a move up to 223? I believe the highs for the year are already made. I don't think we'll go up and retest them again. But feed yards, in my opinion, or the majority of them, are not the ones bidding up for feeder cattle. It could be one or two, and I'll try to make this short. I believe that the issuance of vertical integration and contractual agreements has brought forth some issues that not many people are familiar with dealing with. And a lot of those in a contractual agreement is, in history before feeder cattle were so available, or were not available to this extent, there were times when you could make a forward contract deal and without owning the cattle, and then sometime in the future acquire those cattle and then deliver them against the forward contract. I believe that a lot of the spikes that we see in feeder cattle are attempts at that. There were attempts to sell the board or sell a futures or sell a forward contract, and then at some point in time in the interim, acquire those animals and deliver them. And when that ability to acquire them did not turn out, the person had to go to the market and pay anything that they could to acquire the inventory to have it delivered. That is just my opinion of what some of this happens. Feed yards that I have spoken with don't seem to be very antsy at bidding up for inventory. I think there's very little inventory out there. I think that those that are dealing in this small inventory area are just having to pay the elevated prices in order to participate at this point in time. I believe later on in the fall of the year, when we have more inventory available, prices will come down and you will see greater participation in acquiring these animals. So let's see if we've got anything else. So we lost our audio again. I got the audio back. So I think that if anybody has any more questions, please feel free to put them down on there. Yes, the audio is being recorded and it will be available on my website very soon. I can't tell you when, but within a couple of days to have it on there. So you can review this. Please feel free to call me at my office at any time at 877-863-2206, and I'll be glad to answer any questions that I can. And I really do appreciate all of you all joining in and participating in this webinar. Hope each and every one of you have a great day.